All right, as I mentioned earlier, there are certain immigrants who are not affected by this Medicaid gap. Again, the Medicaid gap is going to affect citizens, long-term residents, and individuals with humanitarian status, because those are the individuals who should have gone into expanded Medicaid, which we in Texas don't have. But immigrants who would not have been eligible for the expanded Medicaid are eligible for subsidies below 100%. So we have a tool to assist with recognizing those specific immigrants. So if you're on the resource page, you're looking under the tab, How to Identify Who is Eligible for Subsidies if Income is Less than 100%. And we have 4 different categories of immigrant eligible. So certain green card holders, employee authorization document holders, certain visa holders, and certain new citizens above the age of 65 who are ineligible for Medicare. So I have a couple examples that can assist us with utilizing this tool because this is really the quickest, easiest way to identify an immigrant who's eligible under 100%. Now again, if you've worked out their income information and they're above 100%, you don't need to worry about this step. It's for consumers who look like they will be below 100%, who you believe might still be eligible for subsidies. So we're going to take a look at that first question. Mary states that she has a green card, has been here since 2015. The category on her card is GA8. Is she eligible for subsidies below 100%? Why or why not? So we're going to go to our tools. We're going to use the legal permanent resident option to figure out whether she's eligible below 100%. So that's that first option under how to identify who's eligible for subsidies if income is below 100%. So if you are a tax preparer or you've ever done taxes and you've ever used the 1040, this works kind of along the same lines. You're going to go in order, question by question, answering the questions and being guided by the questions. So the first question, did you enter the U.S. before August 22nd, 1996 and live continuously in the U.S. since August 22nd, 1996? So the answer for this consumer is no, right? She's only been here since 2015. So what do? If the answer is no, we go to question 2. So the answer is no, we go to question 2. Is resident since date within the past 5 years? If yes, we go to question 5. So we're going to skip questions 3 and 4 if the answer is yes. And the answer is yes because her green card shows 2015. So that is within the past 5 years. So because of that, we skip questions 3 and 4 and we go to question 5. Did you arrive in the United States with humanitarian status? And what we're looking for now is that category card. And you can see for her category, it's GA8, which on the tool shows us she is an asylee. What that means is she gets treated as though she's a citizen, and because of that, she is not going to be eligible under 100% of the federal poverty level. So she'd need at least 100% FPL income estimate to qualify for subsidies. Let's give another example. So we have Willow. Willow is single and has been a green card holder since 2010. She moved to the United States from Sweden to pursue music. Is she eligible for subsidies below 100%? Why or why not? So she did not enter the United States before 1996. We know that because she arrived in 2010. So we go to question 2. Is resident since date within the past 5 years? No, it's not. 2010 is not in the past 5 years. So we're going to go to question 3. Have you worked and paid into Social Security for 10 years? So basically, every year a consumer works in the United States, they earn 4 quarters towards their Social Security. So a green card holder who has been here less than 10 years cannot have earned that. So we're going to move to question 4. Are you married? Okay, so if this consumer was married, we would need to consider the length of time that they'd been married and whether them and their spouse had earned their 40 quarters together. Now she is not married, so we'll go to question 5. Now you'll notice I say she came here from Sweden for music. I do not give you the category code, but suffice it to say, it would be pretty unlikely for us to have an asylee, refugee, or humanitarian status green card holder from Sweden. That just doesn't happen. And for that reason, we can safely say that this consumer did not arrive in the United States with humanitarian status and that they should be eligible below 100% of the federal poverty level. So even if her income is below 100%, this consumer will be eligible for a tax credit. So Mary will not, because of her asylee status, because we treat her like a citizen, which means she's left out in the cold in Texas, but Willow is. I'm going to give you guys a couple of, well, we can just go over it together. So question 3, Bill is a citizen. He's worked in the United States for 20 years. His wife Lucy has a green card, and that shows she's been here since 2015. Is Bill eligible below 100%? Is Lucy? Why or why not? How do you prepare this application? Which is a trick question because we haven't talked about the application. Suffice it to say, we know kind of right off the bat, Bill is not going to be eligible below 100% because he's a U.S. citizen. So he should have gone into expanded Medicaid. So we know that right from the get-go. The question is going to be Lucy. So Lucy has a green card that says she's been here since 2015. So has she been here since 1996? The answer is no. So has residence since date within the past 5 years? The answer is no. So because of that, we skip questions connected to her Social Security and that of her husband. And as long as she doesn't have asylee, refugee, or any other humanitarian status, she will be eligible below 100%. So Bill, her husband, will not, but she will be. And this is why those two categories of questions are important, because we see mixed status households like this. For Winston, we would want to be taking a look at the employee authorization card document, which you would see is underneath legal permanent resident. So that document has different status, but what's important here is whether Winston has either DACA or humanitarian status. If he does not, he's going to be eligible below 100%. And the trick here is that once you're accustomed to using the green card document or the logic of the green card document, you may be tempted to apply its logic to other statuses, but you cannot do that. You need to use the appropriate tool, which in this case is different than the green card tool. And you can find all of those on the resource page. So just a couple of reminders. The checklist on the tracking list is, of course, intended to let you identify the type of income the consumer has, but it also can be a guiding mechanism for you in figuring out what types of incomes count as income for purposes of the application. There's a spot as well to total the 2018 application estimate and the number of people in the household, a place to locate where the FPL level is. You can circle where the consumer's FPL is. And if they are eligible below 100%, this is where you can indicate that. On the resource page, we have, of course, the FPL chart, certain repayment caps, how to explain MAGI, and where to look if you need to figure out if a consumer is eligible for subsidies below 100%. There are a couple of instances where the income doesn't matter, although this is unusual. The first is that we've talked about this. If there is an employer offer of coverage that's adequate and affordable, the consumer will not be eligible for subsidies, which means we have no reason to enter the income on the application because they're not eligible for subsidies. Likewise, if the income estimate is close to or above 400%, this would be another good time to skip questions about income because you know the consumer is not eligible for subsidies. Always a good idea to show the consumer the cost of those plans before actually doing an application. They can make a decision then if those look like affordable, good options for them. And if they are good with that, then we would do the application. But don't do that the other route. If you do answer no to the question about whether or not you're interested in checking for financial assistance, the application will automatically leave out the income section, which is what we want, because we shouldn't be using income to figure out a subsidy for these two instances. Again, these are unusual, but it's important for you to be aware of them. So looking ahead to what happens in terms of this income estimate. So as I've stated, the application relies on a two-step process. So we start by estimating a 2018 income when we do the application to enroll them. And then at the end of the year, the IRS will check the income they've earned against the income we estimated. If they have overestimated their income, they might have some money coming back to them. But if they underestimated their income, if they say they were going to earn $12,000 and then earn 24, they might be paying some of that assistance back. So a couple of things to be aware of. If a consumer predicts their income to be above 100% of the federal poverty level, but you wind up earning less, the IRS will treat the consumer as though they were eligible for taxes below 100%. So there's never going to be a penalty for overestimating. You won't have to repay anything if, for example, you estimate your income at $15,000 and then you only make $7,000. The consumer will not be liable for any kind of repayment. Cost sharing is never reconciled. So if you were estimating your income at $15,000 and receiving that 94% cost sharing, and then it turns out your income was $27,000, you would have to pay back some of the tax credits, but you would not have to pay back any of that reduction in your deductible, out-of-pocket max, and copays. If the final income, just to reiterate, if the final income for the year is below 100%, the consumer will be treated as eligible for credits, and they will not have to pay back anything. And again, though, most importantly, if the consumer winds up underestimating their income, there are limits, there are caps to what they have to repay. So the caps will depend on whether the consumer is single or not single. So for consumers who are single and whose income winds up being between 100 to 200% of the federal poverty level, their max repay is $300. For consumers who are single and whose income winds up being 2 to 299% of the federal poverty level, their max repay is $750. For 3 to 399%, it's $1,275. And for 400% of the federal poverty level and over, they wind up repaying the full amount. So while these may look like very large numbers, in and of themselves, they tend to be quite generous. And I've been in many circumstances where I'm explaining to a consumer who's having to pay money back out of their refund on their taxes, and I have yet to come across a circumstance where it wasn't something the consumer could understand once it was explained to them. Without that explanation, of course, they're not pleased to get something taken out of their taxes, but that's why we do what we do, and we're able to assist tax side with making sense of why they're having to repay some of that tax credit. Sometimes a good way to explain this, I think, is that if a family member gave you $20 to pick up groceries and the total cost of those groceries came to be $14, you would pay that family member back $6. Reconciliation essentially operates under the exact same principle that you were sort of overpaid, and at the end of the year, that family member, the family member being the IRS, will see that and will basically want the amount that you shouldn't have received back. So that's sometimes a useful way to think about reconciliation and a useful way to explain it to consumers.